Friends, it is my privilege as the convener of our study circle to host the knowledge sharing morning on a subject of great professional significance. NFRA, Prospective Standards of Auditing. In today's evolving regulatory environment, staying updated is not just a responsibility, it is a necessity. And to who better to guide us on this journey than our own past convener, CA Chintan Shah, a distinguished professional, a past convener of this study circle, and a person whose insight and clarity have always left us richer in understanding. इनके लिए बस इतना ही कहना चाहूंगा सर कि जो विषय को ऐसे समझाएं जैसे कहानी सुनाई जाए, ऐसे वक्ता हमारे बीच हो तो सीखना आसान हो जाए। नफरा और ऐसे सुनकर जो लोग घबरा जाते हैं और सीए चिंतन शाह जी को सुनकर सब कुछ समझ में आ जाते हैं। And now I request our past convener CA Jai Shah to give a brief introduction of our speaker CA Chintan Shah.
Good morning, everybody. Thank you for the opportunity, convener. Chintan doesn't need introduction to this forum, at least. But nonetheless, as formality requires, I'll just try to introduce in brief. Chintan is a 99 batch chartered accountant with a rank holder. He is a LLB, that also he cleared with the rank. He has given a lectures as a professor in MBA college that gives us his flair to speak as a speaker. He's a regular speaker at WRC and various forums of institute and MBA colleges. He's a prolific he's working on a various committee of the institute also. He has in the past and presently also he's working on various committee. With this brief introduction, I introduce you with Chintan. I request all of you to give him the round of applause.
I also request our past convener
Morning, friends.
Good morning.
And thank you, convener and Jayesh and all the other dignitaries for this opportunity of sharing insights into something which has been the talk of the town every day. And definitely there has been a lot of discussion about NFRA taking actions against the CA fraternity. Friends, let me start with a quote. It's very, very famous and dear to my heart. It's good to learn from your mistake, but it's better to learn from other mistakes. So that has been said by very veteran investor Warren Buffett. हिंदी में जैसे कहावत है, दूध का जला छाछ भी फूक फूक कर पीता है, दूध से कोई और जला लेकिन छाछ हमको फूक के पीनी है. So that is the meaning of this saying, if you say. जैसे हिंदी का माहौल कैलाश जी बना देते हैं, हम भी सीख रहे हैं कि हिंदी में वार्तालाप कर सके. Thank you, friends. So by this, everybody will just take something in the history. The two famous scams which shook the entire fraternity and the corporate world. One was the Enron and another was the Satyam. World over, Enron came and the big five were reduced to big four. Arthur Andersen has to shut shop. Satyam scams came. 5 CAs were debarred for life and had to pay penalties worth lakhs of rupees. Everybody is aware of it. So we know just creating a background what happened in the past. So we have to learn from other people's mistake and ensure that we don't make the similar mistake. So today we'll talk about something on the compliance of standards and auditing, how the NFRA looks into it. This is a broad agenda for the day. As per the time permits, what is NFRA? Its composition, jurisdiction, scope, its roles and powers, inspections, penalties and debarments, what it can levy. Just a run up on the standards on auditing which have been prescribed and applicable as on today. Case studies. These are some case studies which I have prepared, and as per time permits, we'll go through them. National Financial Reporting Authority. It is in the background what happened after the Satyam scam. The committee recommended to the Companies Act that there should be some authority who should oversee this function. And that is how an amendment in section 132 was made. Companies Act 2013 was amended and section 132 was introduced, which gave the power to the government to form and constitute some authority which is autonomous and which is not controlled as such by the government, but an independent autonomous body to oversee the functions of auditing and assurance carried out by the CA profession. NFRA plays a very, very crucial role in creating confidence amongst the stakeholders and the general public for the reliability and the readability of the financial statements. Its jurisdiction extends to listed companies. All listed companies are covered by NFRA, SME as well as the main board. Unlisted companies whose net worth is above a threshold. And also some companies who are registered outside India and foreign subsidiaries of Indian companies. What is the composition of NFRA? It consists of one chairman and maximum 15 members. It's okay. NFRA at present is composed of one chairman, 2 full-time members, and 9 part-time members. The present chairman is Mr. Nitin Gupta, who was. You want me to continue or? The present chairman is Mr. Nitin Gupta, who was appointed very recently on 23rd July 2025. Prior to that, Mr. Ajay Bhushan Pandey was a chairman who served for more than 3 years. And in a very brief period from 1st April 25 to 23rd July 25, Mrs. Kaur was the chairperson of NFRA. Our president, ICI president, is the ex officio member of the NFRA, apart from the other members. What are the roles and powers of NFRA? Its responsibilities recommends the accounting and auditing standards. It has cut the powers of ICI. Earlier, ICI was to recommend accounting standards, but now it is NFRA who recommends and institute has to implement it, as well as we members have to follow that. So there was something called as NACAS, National Advisory Committee on Accounting Standards, which was replaced by NFRA, and institute has to follow the recommendations as done by NFRA before issuing any standards on auditing or accounting standards. It has the powers of a similar to a court. It can summon you, it can investigate, it can call for witness, everything. So it is similar to a court. Penalties can range from few lakhs to few like 5 times of the fees what we have received, 10 to 5 times, and it's got debar members for a large period of time. If anybody is dissatisfied, we can appeal against the NFRA orders. NFRA has two roles. One is inspection and another is order. There is a difference between inspection and order. Inspection is something which is suo motu done by NFRA on some firms depending on the size and the complexity of the audits undertaken by them. So it will suo motu send some questionnaires, interview them, learn the processes, and ensure and give them guidance to improve the processes so that the audit quality is improved. It is very, very milder than an order which is passed by the NFRA. Order is very strict and it is related to some specific client case done as an audit by any CA firm. So as of now, NFRA has inspected 12 firms and issued inspection orders which are available on its website. We can read them. These are more of recommendatory nature and they give you guidelines to improve the auditing processes across the firm. What people are afraid about are the NFRA orders. So as of now, 103 orders have been passed. You can see the amount of penalties being levied ranging from 10 crores on one order only, it was 10 crores. To 2 orders, it was 0 penalty also, but the maximum is ranging between 1 lakh to 5 lakh. Debarment. They have debarred the CA firms, CA partners, engagement partners, as well as engagement quality review partners who are engaged in the audit of listed companies for multiple years, ranging from 1 year, 5 years, 10 years also. Just a quick recap. What is standards on auditing? We all are members of our institute and we are required to follow all standards on auditing mandatorily in all audits, irrespective of the size and the nature of the client. The standards on auditing are the guidelines for conducting an audit. It is said that if there were no rules, accountants would be having fun. In a sarcastic way, that unless there are rules, we will not be following them. So they cover the auditing procedures. It is aimed to ensure that the audits are standardized and respectively, readability of the auditing the reports could be compared. It is issued by the AASB, Accounting Assurance Standards Boards of India. Again, after the recommendation and the approval from the NFRA. Our standards on auditing are aligned to the international standards. As I told, it is mandatory for all audits, irrespective of size and nature of the client. And non-compliance may lead to penalty, sanction, disciplinary action by the ICAI also. So ICAI and NFRA both look at it in a very, very harsh way that if there is any non-compliance, if there is any non-adherence to the standards on auditing, we can be penalized, ranging from, you have already seen what. Just quick recap on the standards on auditing which have been already prescribed and which are mandatorily to be applied in all audits. Just do a quick run. There's a set of essay under the two, there are divided into different sections. Section about 200 is the overall audit. 300 is about planning. 400 is about some special considerations in fraud. 402 and 450 is evaluation of misstatements identified during the audit. Series 500 is about audit evidence. It is said that audit evidence should not only be sufficient, but it should be appropriate. So it should have quality as well as quantity whenever audit evidence is gathered. 550 is related parties. 600 is using the work of another auditor, using the work of internal auditors and another auditor expert. 620. 700 is the forming of the opinion. So after the audit is done, we are required to give an opinion, that is the audit report, which is the culmination of the audit what we have conducted. Series of 800 for special consideration, and there are some review standards, SRE 2400 and 2410. Friends, there has been some interesting cases which have happened, and that is where we need to be aware. We need to just learn from them and ensure that those similar mistakes are not repeated at our end. So first I'll take up Reliance Home Finance Limited. Another which I have prepared is Religare, Coffee Day Global, because the Coffee Day Global is something which has been charged the highest penalty of 10 crores as on today. Only one order with 10 crore penalty. CMI Limited and SRS Limited. Reliance Home Finance, very famous case. Anil Ambani Group. Recently also there has been ED raids on the Ambani Group related to this case for siphoning of the funds. Hardly, I think 10 days ago, there was an article in the newspaper that along with Yes Bank, and there was some ED raids on some multiple premises of the Anil Ambani Group. This order was passed on 26th April 2024 for the financial year 18-19. Just set the background what happened. Here, one Big Four was the auditor for Reliance Home Finance for the financial year 18-19. They filed a report to the MCA stating that there is a possible fraud and we are resigning from the firm as an auditor, and they exited without giving an audit report for the year ended March 19. So what happened next? That report was filed on the MCA portal. MCA informed it to NFRA, informed it to SEBI that there has been a report filed that a fraud is suspected in Reliance Home Finance, and thus the auditors have resigned. After the resignation of auditor, immediately another firm was appointed as an auditor, which took up the mandate and completed the audit, and the audit report was filed and available to the general shareholders. Something fishy was smelled. NFRA took up this matter and suo moto started an inquiry against the audit firm which actually issued the audit report in case of the Reliance Home Finance. And just imagine, pertaining to 19, report coming in 24, the agony which a person would have gone through so many years till the conclusion comes. What happened in this case? The new audit firm was accused of accepting the appointment as an auditor even before obtaining an NOC. All are aware, friends, we cannot accept an audit unless we communicate with the previous auditor, obtain a no objection, and then only we are authorized to issue an acceptance letter for an audit. But here, the new firm was in too much of hurry. Again, it could have been pressurized with the management. You don't know the facts in detail, but this was what was happening. They accepted the audit. They issued two types of acceptance letter. One saying that we are accepting the audit subject to the receipt of NOC, something which is not there in the normal parlance. We never issue a subjective audit acceptance letter, but they issued such letter, and also they had issued another letter stating that now we are accepting the audit as we have received the NOC. So this was what was not acceptable to the authorities, that how can you accept an audit without even having an NOC in your hand. So again, if we go through the accounting standards on auditing, there are two standards which say SA 300 and SA 200. 300 states the outline of the responsibility of the auditor to plan the audit effectively. That is a planning standard. It requires communication with the previous auditor. Also, identification of the engagement risk, the client risk, whether we should accept that risk client or not. Even SQC1, how many are aware of SQC1? In the members, how many of you are aware of SQC1? Anybody? Okay, so SQC1 is the standard on quality control which has been issued by the ICI. All CA firms are mandatorily required to follow that. It is more of a control mechanism that how an audit should be conducted and basic controls which a firm should apply in its firm so that the quality control in an audit is maintained. So even SQC1 requires that there should be an audit acceptance, client acceptance mechanism, which we should do. Whenever a new client is onboarded, we should do a basic ground check about this integrity, about its, how it is, what are the normal KYC norms. These are something which is required as per SQC1. Here, the engagement partner, as the non-compliance which was stated was accepted the audit engagement prior to obtaining NOC and violating ICI, SQC1 as well as SA300. The planning documents were dated before accepting the NOC. See, when this charge was levied against the partner, they said that, oh no, we did not accept the audit, but we had just given a conditional acceptance letter, again, which was something, eyewash in the funds of the authority, but which was not accepted. It was found that they had audit planning meeting, which were attended with the engagement partner by the EQCR, and they were dated prior to the NOC being issued by the auditor which had exited the firm. So it was they were charged with non-compliance of SA 300. SA 200, which sets the foundation, for the auditing standards and require the auditor to exercise spectism. Spectism is something we have to exercise throughout the audit. And it is said that we should start our audit as if there is something fishy. We should doubt the client unless proved otherwise. So, we should always have that mind to question and, we have to start on the premise that there is something wrong and we have to rebut that assumption with proper documentation and evidence. That is what the standards on auditing require us to do. Here also, the engagement partner did not demonstrate any spectism being followed. There was no planning mechanism. Despite being red flags of the related party, again, there was a report being filed by the previous auditor saying that there is a suspected fraud. But again, there was no deep diving, nothing being done by the auditor to ensure that this is being ruled out. Oh, console. The auditors were charged with non-compliance with SA 300 also. In this case, there were many facts which the earlier auditor already mentioned in his resignation letter as well as the report which was submitted to the MCO under section 143(12). There is a suspected fraud. He had already stated that there were some evergreening of loans. Some loans, there was some round tipping of funds, and the loans were given to some related party without any purpose. So the auditor was mandated to go into these details, check what was the suspicion that the previous auditor was looking into it, but there was nothing being done, and he just signed off the audit report. So thus he was charged with violation of SA 200 also. 143(12) of the Companies Act requires that whenever there is an audit and the auditor suspects that there is a fraud being there in the organization, he has to report such fraud to the MCA. That is what the earlier auditor did. He did his duty and he resigned. But this auditor did not do anything about it. The earlier auditor reported there were frauds of around 7,900 crores, and the EP, the engagement partner, failed to analyze the ADT4 and do any deep diving into it. That was the charge being levied by NFRA on the new auditor. The auditor solely relied on the management representations and explanations, and he concluded that a fraud did not even exist without evidencing professional spectism or any further due diligence into the matter. There is one more SA 240, which states that what are the auditor's responsibility when there is a suspected fraud. So this was another essay on which the NFRA took a serious stand, and he was charged for violation of non-compliance with SA 240. Wherever there is a suspicion to a fraud, it is said, even in the standards, it is said that we have to start with the assumption that there is a fraud in the revenue. And we have to ensure and rebut the presumption that there is no fraud. That is the expectation from the standards on auditing, and which there was no work being done by the auditor to rebut this presumption, which they could prove to the NFRA that they've done this audit, they've done this work and rebutted the presumption about the fraud. No, they were required to analyze the unusual journal entries, so many book entries which were there. All this was not done. So NFRA, they've already stated in this that the engagement partner did not test the management override of controls, did not analyze unusual journal entries, and did not evaluate red flags such as the shell company borrowers, intercompany fund transfers. And NFRA held that EP audit documentation reflected routine audit procedures lacking depth, failing to address fraud indicators and control weaknesses. There were definitely management overrides of control because fraud was happening. Management was overriding controls to fund its group companies from this company so that he could make the other companies have funds. SA 570. SA 570 is about the going concern. All the financial statements are prepared on a going concern basis, and we have to always challenge the going concern assumption and ensure that the going concern assumption is still valid when the financial statements are prepared.
A question,
Please.
in case of Reliance Holdings, outgoing CA, any action taken against them?
Yeah, definitely. That is the climax of the slide. Please wait.
I have resigned. So do I have a right not to give objection letter?
Sorry?
No, the previous auditor had resigned.
Right.
So the new auditor should he take the consent of the other auditor, the resigned auditor, because he's no longer an auditor.
But sir, our ICAI code of conduct requires that we have an NOC before you accept an audit.
Okay. Second part is, after having given the conditional acceptance letter, did he actually start the work before getting the NOC?
Yes, that was being proved. That was being proved because there were meetings which were dated prior to the acceptance of the receipt of the NOC from the auditor. So that was proved. The charge was proved. That was why the case has been, he was charged with the non-compliance of these standards. So SA 570 talks about the going concern assumption. An auditor is always required to check, wherever there are some flags about the vitiation of the going concern assumption, negative net worth, continuous losses, downgrading of the credit rating of the organization, senior management team leaving the companies. What happens, right? A sinking ship, people leave the organization. So these are some indicators which we are required to check and ensure that if there is any such indicator, we have to go deeper to assure ourselves that the going concern assumption is not vitiated. Suppose the going concern assumption is vitiated, what happens? We have to prepare the financial statements on a liquidation basis. All the assets and liabilities have to be valued on realizable value instead of a historical cost value in a normal company, and the market value or the present value, fair value as on the Ind AS financial statements. So if the going concern assumption is not valid, it was the duty of the auditor to ensure that the financial statements are prepared on a realizable value basis. Here there were indicators which showed that the going concern assumption was not completely valid. There were downgrading of the credit rating of the company. They were doing restructuring of loan again and again, which is an indication that the company is not in a good shape. What happened here? The auditor did not do anything about it. They accepted the management representation that the going concern assumption is valid. In this, there were some forecasts being made by the management and accepted by the auditor without even challenging those assumptions. We as an auditor we should not blindly accept any management representation. We have to challenge the basic assumptions under which the management representation has been given. Some common sense has to be applied, that whether this is in line with the historical data, whether is in line with the other economic factors and the economic scenario in the country as well as in the environment in which the company is operating. You cannot have something very, very rosy in a economy which is not performing, or you cannot have a cash flow forecast which is says that, okay, I will make 100 times the profit which I did in the last year. So there were indicators which required the auditor to deep dive into it, but there was nothing being done. So he accepted the management representations blindly and said that, okay, the going concern assumption is valid, and thus the financial statements are prepared on the going concern basis. There were, in this case, there was an intercreditor agreement which was entered into, whereby the loans were again and again, you can say, evergreening of loan or making them live again and again by just doing some transactions. The money from the borrowers or lenders which they had money had given, there was no recovery of the loans. Even the interest was not coming. So the asset itself, in a finance company, the loan is an asset. And if that asset is not giving me the income which is required to be given, there is an indicator that something is wrong. But all these indicators were ignored and nothing was done. Further to this, the essential procedures of assessing the credibility of the cash flow forecast was not done. Debt repayment schedules, again, nothing was done. And the arithmetical accuracy was checked, and the auditor said that I have checked it, but see, checking arithmetical accuracy is not our job. We have to ensure, have a skepticism again here to say that whether these forecasts are at least comparable to what could be achieved in future. Again, there was no emphasis of matter or a qualified opinion despite of overwhelming indicators of uncertainty. And NFRA stated this demonstrated gross negligence and a direct violation of SA 570 requirements. Yeah.
You said the loan given on which there was no interest being received by the company, but the interest, was it being accounted on accrual basis at least?
Yes, the interest was accounted.
So income itself was inflated. When
Everything was inflated, asset, liability, not liability, assets and revenue both. SA 500 and SA 540 talks about audit evidence. 540 talks about evaluating the reasonableness of the estimates. Audit evidence. What is an evidence? Evidence is something which we are required to obtain, and we have to comment in our audit report whether we have obtained sufficient and appropriate audit evidence based on which we issue the audit report. We just recall the audit report what we issue, though many times it's just more of a copy paste work with a change in date. But please read the audit report what we are issuing. We are stating that we have, based on the audit evidence which is appropriate and sufficient, we hereby give a report that there is nothing, no material misstatements in the financial statements. So we are required to obtain sufficient and appropriate audit evidence. Sufficient means which is in terms of quantity, and appropriate means quality. The audit evidence which we gather has to be appropriate in quality as well as quantity. You cannot have just loads of paper which has no purpose, right? So it has to be a qualitative audit evidence which we gather and based on which we conclude that the financial statements are free from material misstatements. And so here, what had happened, Reliance Home Finance, what does the name suggest? It is a home finance company. What it started was, it started lending for general corporate purposes. That is, it deviated from its main object of home finance to giving loans to corporates. This was the main big red flag which could have been raised. I don't know the memorandum, but it could be a ultra vires the memorandum also. This could be another area which many times we ignore whether the business being conducted by the company, whether it is in the memorandum, whether it is allowed to carry out that business. There's a basic fundamental thing which the auditor has to always check, because many times companies start new business without amending their memorandum and articles. So here the company started lending for general corporate purposes. The loans amounted to more than 7,900 crore out of the 17,000 crores loan book. So more than around 50% of loan book went from housing finance to corporate purpose loans, which was a big indicator of siphoning of the funds being started. Here again, there was no procedure. Whenever you give a loan, what will happen normally? You would check the credibility, whether the borrower is capable of paying the money back, whether he is servicing the interest, what is the end use of the purpose or end use of the loan being granted. These are the basic checks any lender of the money would do. But here everything had failed. There was no checking of the borrower's companies, the credibility, the loan repayment capacity. In fact, what had happened, new freshly incorporated companies were formed. They were giving money, and that money was routed from somewhere to other companies to again fund some of the Reliance Group companies, because again the intention was to create fraud. So the basic internal checks about whether whenever a borrower comes to you, whether you are doing its basic check round, his credibility, credit rating, nothing was done. And again, no evidence was gathered, and the auditor also failed to ask for any evidence about the borrower who had borrowed money from this Reliance Home Finance. The next question was about 540, which says that the accounting estimates which are being done by the company, whether we have validated those estimates. In the accounting field, there are many estimates which the management does. If we talk about the general estimates, very common estimate which a company does is the life of the asset. And based on that, a depreciation is charged every year. That estimate, see, schedule of the Companies Act, schedule 3 of the Companies Act, sorry, not schedule 14. I think I'm missing the number. The depreciation rates and the life of the assets are being prescribed. The companies are required to follow the life of those assets and charge the depreciation accordingly. But the management is free to charge depreciation on a higher rate or a lower rate, subject to its being able to demonstrate that the life of the asset is not as per the prescribed life, but it has something different. So again, an estimate element may come, and we are required to evaluate those estimates done by the management and ensure whether the depreciation being charged by the company is appropriate or not. It could be a very easy way to inflate or deflate the profits if the depreciation is not charged appropriately. In this case, it was about the ECL, expected credit loss. Ind AS 109 requires that on your loan book and the other assets which are subject to recoverability, you make an estimate of estimated credit loss and account that. ECL is nothing else but something called as provision for bad debts. In old terms, we had provision for bad debts. Now it is called ECL, estimated credit loss. How do you evaluate estimated credit loss? There are some complex mathematical models whereby you evaluate the probability of default as well as the loan, if you know the loss given default. There are two technical terms which are used to calculate that, I have a loan portfolio, divided into different buckets, different maturity, different segments whom I have given the money, and based on these parameters of probability of default and expected credit loss, I would make a provision for the loss which would be occurring if there are defaults by the borrowers.
In case of interest, he asked a question. The overdue interest visa also is required to be created.
Yeah, so
accrual interest is accounted on accrual basis and it is not recovered.
if you see any current assets which is not recovered, ECL provision is required as per Ind AS 109. So in this case, just imagine a total ECL was provided of 278 crores, loan book of more than 16,000 crores, out of which the general purpose loan book was around 7,800 crores. So do you think the ECL was appropriate? The auditor said, yes, I have checked the accuracy, and according to me, the ECL being provided is appropriate. But when NFRA went into it, the auditor could not demonstrate whether the ECL provision was appropriate or not, because the model itself was faulty. They had used some indicators, some presumptions which were not appropriate, and thus the auditor was charged of neglecting the adherence to this standard SA 540 and making shorter provision to what was actually required in the balance sheet. SA 220 and SQC 1 we just spoke about a while ago. SA 220 calls about the scope of the auditor's responsibility and the overall audit control in the audit engagement. Client acceptance and continuation procedures are mentioned in SA 220, which is one is required to be followed. Assignment of engagement teams, what teams you are engaging, how you are planning an audit, and engagement performance being there. So you have to document all those as per SA 220. And one very big requirement of SA 220 is appointment of the engagement quality review partner. In any of the listed company audits, this is a mandatory requirement. The engagement partner has to appoint an additional person called an engagement quality review partner. What is the role of this person? He has to challenge the conclusions being drawn by the engagement partner. He has to question the engagement partner how he has arrived at those conclusions. Again, these has to be documented. The challenges which he did, the conclusions which he have arrived, and whether he has accepted or there has been modifications in the conclusions being drawn by the engagement partner. It is mandatory that the engagement partner cannot sign off unless the EQCR procedure is completed. In this partner, the EQCR participated in the planning meeting before the auditor's NSE. There was a violation. There was no documentation which evidenced that the EQCR actually did his work because nothing was done. He had not challenged the conclusions being arrived at by the engagement partner, which could be very evident. ECL not checked. Going concern assumption not verified. So these were the requirements which the engagement partner was required to check whether the conclusions drawn by the engagement partner are appropriate and whether this requires any revision in the financial statements or the audit report. But nothing of that sort was done. Investigations were going on, but no deep diving was done. Because there was a fraud, there was a financial instability. There were so many things happening in the company, but everything was overlooked by the audit firm and the engagement partner here. A commentary on the EQCR was missing and no formal quality control review memorandum was available on the file. So what NFRA has commented is at the firm level, there was a complete breakdown of the quality control. SQC1 also talks about the quality control, which a firm is required to follow in terms of an audit. Whenever a firm is subjected to peer review, SQC1 is the document which the peer reviewer looks into it and he concludes whether the peer reviewed firm is following the procedures as mentioned under SQC1. So these failures, systematic deficiencies in the firm's compliance, particularly with respect to independence, engagement acceptance, and monitoring of the audit quality, and they were charged with the violation of SA 220 and SQC1. Yes, sir.
Suppose the supervising partner finds that engagement partner has not conducted the pre-test practice. So in that case, they are supposed to give what happens to the audit report which is already in case.
Sir, I just spoke. I'll just go back one slide. If you read it here, responsibilities of the engagement partner: ensure appointment of a quality control reviewer, discuss significant audit matters with him, do not date or sign the audit report unless the EQCR process is completed.
That is before release GST.
Yes, sir, definitely. Otherwise, what is the purpose?
Yes. That is just to release another.
No. He cannot release the report till the EQCR process is completed. That is mandated by SA 220. SA 230 talks about documentation. Documentation is something which is must in all audit. It is said that if there were no documentation, forest would have a chance to stay. You can just think the sarcastic way it has been put, a quote has been put, that if there was no documentation, forest would have chance to stay. So it says that you have to create so much paper, so much documentation that even forests are required to be cut. But again, in the digitized world, we have digitization, we have copies which are like, in manuscripts which are more of digital nature. So we did not cut trees, but point is that we need to have so much of documentation that we could be able to prove that we have conducted the audit as per the standards on auditing. We have maintained sufficient and appropriate, I'm using the word again and again, sufficient and appropriate audit evidence, which could prove that we have conducted the audit as per SA 230. Assembly of audit file is required to be done. We have to gather all the audit documentation and within the stipulated time frame. What is the time frame being allowed by the institute for assembly of audit file? Anyone? Perfect. 60 days is the time frame which the institute allows for assembly of audit file. Similarly, the UDIN generation has been aligned to it. That's the reason we are allowed to generate UDIN till 60 days. It is not random number. SA standards on auditing allowed that we can assemble the audit file within a 60-day period from the signing off of the audit, and thus the UDIN generation has also been allowed 60 days. We cannot alter or change the documentation. If an alteration is required, we need to document why this documentation was changed and the reason for that. Here in this case, the documentation prepared by the audit team was severely deficient and non-compliant in terms of SA 230. Key documentations which were required, like communication with the previous auditor, the ADT 4 which was filed, the copy of that, nothing was available on the record. The going concern assumptions, documentation of sample selection. Again, SA 570 talks about the sampling. We are required to do a sampling, and again that has to be documented how the sampling has been generated. So there was nothing about the sample selection process being there. Inadequately recorded and lacking any substantial evidence. NFRA also found that the audit planning document was dated prior to the issue of the receipt of the NOC. And thus procedural violations were blatant in this audit. It was signed off, conclusions were drawn, there were no indexation, there was no traceability of the documents. Again, you should be able to retrieve a document if required, right? That is the crux of a documentation. It cannot be a random pile of papers where you cannot find anything if you are required to do. So all these were missing. Reflect any rationale behind sampling techniques used, the population size, or the extrapolation of the test result. When you use a sample and a result is generated, how do you extrapolate that result to the audit findings? So that is what was expected, but everything was missing. Structural, sequential, and reasonable record demonstration, a gross failure, and to exercise professional care and fulfill the documentation of SA 230. That was a remark which NFRA passed in this case. SA 620 talks about the auditor's responsibility when using the work of another expert. Whenever there is something in the financial statement which is non-financial, we normally use the work of another expert. It could be maybe actual valuation which we normally use. We are not expert in the valuation, we used an actuary report. Again, if the life of the asset is something different as prescribed by the Companies Act, the company would take an engineer's report. So this is an external person whose work we use. So whenever we are using the work of an external expert, we have to demonstrate against skepticism. We cannot accept that report at blind and just on faith and what as if the management has given that nothing is sacrosanct. You have to have your basic intelligence, basic common sense being used in that to ensure what work he has done is in line with the overall facts of the case. In case of gratuity, many times it happens that the HR department will give some data which is not in line with the actual number of employees. So the valuation report will come wrong. So basic checks you also need to do. The total monthly pay is mentioned in the gratuity report. You should check whether the total monthly pay is matching with the actual wage bill the company is bearing. The number of employees, whether it's matching with the total number of employees on the payroll. Sometimes what happens, the HR team leaves the directors and the EDs who are paid hefty salaries in the list of employees. The valuation report will be wrong. So these basic checks, if we are not doing, we are failing in our duty and we could be subjected to non-compliance of SA 620. We also have to check the basic competence and the capabilities of the person whose work we are using. You cannot say that if a person is not authorized as an actuary, he cannot issue a report. So this basic checks, it's our duty to do before we take that as an accepted document in the conclusion of our audit.
So my point, it's not related to this case. When we are issuing certificate of the era, the engineer also gives the report case which work has been completed. Should we get into the technicalities of that also?
I'm not getting into technicalities. Point is, you should have your basic general knowledge and common sense being applied to that report, whether it is making sense, right? Suppose you say that the project cost is say 100 and he issues a report which says the 80% work is complete. Can you at least see that the 80% of cost is also incurred? See, because that financial data you have.
Besides that, the building is not there.
So at least Keep your eyes and ears open. You cannot accept something blindly. See, it could be 75-70. That is okay. But it is not even started and you say 80% work is complete. You cannot accept that, right? So some basic checks and balances, it's your duty to do that. So in this case, as the fraud was reported by the previous auditor, what happened? The new audit firm had appointed a law firm to evaluate and investigate whether a fraud existed or not. The law firm gave a report that there was no fraud. This gentleman accepted the report of the law firm and said the no fraud exists. So you can imagine what had happened. Earlier auditor reported fraud. Law firm says there is no fraud. And the audit firm says, okay, management says definitely there is no fraud. And this audit firm also accepted that there is no fraud. The scope of work, the areas of work to be done by the law firm, it was the duty of the audit firm to see whether he has been given proper mandate, whether the scope of work is defined, nothing was checked into it, and blindly the law firm's report was accepted and he reported that no fraud existed. And it is stated that the auditor's opinion was formed mainly solely on the management assertion and unverified correspondence without independently assessing the appropriateness and sufficient of the expert's finding. The key documents referred to the expert report were not even reviewed by the audit firm. See, the law firm mentioned about the communication with the company, communication with the MCA, but he had not even, the copies are also not available with the audit firm. So the blind reliance on the management appointed experts without due diligence or corroborative evidence demonstrated lack of professional skepticism and resulted in misleading audit opinion in a clear violation of SA 620 and SA 500. Summing up all this, the climax which somebody was asking, this was the climax. There is a monetary penalty of 1 crore on the firm. Debarment for 10 years from doing any stat audit or an internal audit of any company. The main partner, the engagement partner, who was the signing partner, 50 lakhs penalty. Debarment for 5 years. The EQCR, he also had failed in the performance of his duty. Penalty of 10 lakhs and debarment for 3 years. As we are talking about the EQCR, the other partner, there was a recent case which went up to Supreme Court, whether EQCR is also responsible and whether he could be debarred and a penalty could be levied. It was not in this case, some other case. So they went, the NFRA order was appealed and it was held that EQCR is also responsible for the misbehaving and non-compliance, and thus he cannot escape his duty and responsibility, and he was also debarred and penalty was levied on the EQCR also. So the role of EQCR cannot be undermined. He has also an important role to play in the conduct of an audit, and he is also subject to penalty and debarment.
What happened to PwC earlier audit?
Sorry?
What happened to earlier auditor?
They went off. They had resigned. And then they have not even issued the audit report. They did their duties in reporting the fraud under 143(12) and they resigned.
Then evaluated over a period.
Yeah, but again, I'm not aware of this. What happened to them, whether any investigation was carried out, not carried out. So
Cannot be a product of 1 year.
sorry.
Cannot be a product.
Yeah, definitely. But see, the general purpose corporate loan started in that financial year. So that was the flag which they raised, and what they stated in their communication to the MCA that our queries are not being responded, and thus we suspect there is something fishy, some fraud is being carried out, and thus we want to resign. So that was the content of the report being filed by that Big Four firm to the MCA.
Suppose I don't want to give NOC. So what should I mention here? Why I am not giving NOC? I have detected fraud.
Right.
Like, no, I have to report something like an MCA work.
Right. And 143.12 requires reporting of a fraud to the MCA.
Then what, if you, write in the NOC, like, no, make you permission there you want it to.
Yeah, but if you have resigned, why are you not issuing NOC? What's the problem in issuing NOC?
Yes, I have to say I'm giving NOC.
Obviously,
Well,
you state that I have already communicated there being a suspected fraud, and thus I have resigned, but I have no objection in you carrying out the audit. You do your own diligence and carry out the audit.
it's the responsibility for the person.
Obviously, see, once you have resigned, it is his responsibility to do his work. Let him do his work.
Then he also has his own measure to take on one.
Definitely. But sir, ma'am, again, lesser said the better. When an opportunity comes, nobody looks into it. And we just accept it blindly. That is the problem.
But we should come together and because
That is see, that is why SA 220 is there. That is why SQC 1 is there. You are required to do a client continuity check every year, not only on first acceptance, whether you should continue with that client or not. Are you following that procedures? If yes, then what is the problem? But point is, we are not following that procedure. That is the general problem, and thus we fall into the trap.
One more point. I give a parallel example of bar council versus CH. As in CH Institute, we are required to take the NOC of the previous auditor. And law firms also, in lawyers also, we are supposed to take the NOC of the previous legal representative and then go ahead and file a new account. That's the procedure. In these cases, some appeals don't give the NOC at all to the newly appointed working. The matter went up to the Supreme Court. Supreme Court said, why is the old law firm not giving the NOC? He was held negligent. He was liable for misconduct in that case. If he has a dispute of the amount not being paid by the client, that's not the reason for not giving the NOC by the old client.
See, CA Institute permits that if after waiting for a reasonable time, the other auditor has not responded, you can accept the audit. So, but that reasonable waiting period should be there. In this case, there was no waiting period. In fact, they jumped into the audit even before receiving of the NOCs. See, institute has its own parameters, you have to follow that.
Sure.
So the next case would be about Religare Finvest. Similarly, pertaining to financial year 18-19, the order was passed on 18th March 2024. Religare was a subsidiary of a famous listed entity, Religare, which was again an NBFC. Business is similar to what Reliance Home Finance was doing. It was an NBFC into the business of borrowing and lending. Here again, SA 540 was the subject matter of the discussion. In Religare case, it was a little bit different. NFRA suo moto took up the matter without anybody referring it to it. So, it saw that there is something wrong, something fishy happening, and they suo moto took up this case, issued SCN, that is a show cause notice, to the audit firm and started its investigation. SA 540, we just saw into it. SA 540 mandates that the accounting estimates have to be evaluated. The reasonableness and significance of the accounting estimates done by the management have to be evaluated by the auditor using skepticism all across. In this case, again, there was the question of expected credit loss, which was not done as per the standards on auditing. The provisions for NPA was significantly understated. Again, documentation evidenced violence of the probability of default and the PD and the loss given default parameters which are there. Again, a complex mathematical model was used, which was manipulated in a way that the ECL provision is very small. One more accounting, I'm not dealing more into the ECL because we already touched upon that in the earlier topic. One more accounting estimate which was challenged here was the deferred tax asset. Very, very nice area of showing my PAT at a higher number. If I book a deferred tax asset, my PAT goes up. What is the requirement of AS 22 for recognizing a deferred tax asset? It states there has to be a virtual certainty of these losses being available for set off in the future period. Very, very cunningly and smartly, they changed the accounting policy itself. They use the word, instead of virtual certainty, they use the word reasonable certainty. So they manipulated the accounting policy itself. You cannot change the accounting policy which is in non-adherence with the accounting standards. There was deferred tax asset being created of 495 crores. There was no certainty that such amount of losses would be available to be set off in future period, which would be available so that I could recognize these huge amount of deferred tax asset. The auditor did not evaluate these things. It was a mandatory thing to see whether such assets even exist, whether such losses would be available in future. Again, what you need to do here, there has to be some forecast, whether I will be able to make such profits to whereby the losses will be set off. Again, those forecasts need to be challenged. Those forecasts to be in line with the expectation and the historical data. Nothing was done, and the deferred tax asset of huge 495 crores was accounted in this company, and which went without the attention of the auditor, and thus he was charged for violation of SA 540, that he did not have the accounting estimates were not evaluated properly. (240). Again, auditor's responsibility in case of a suspected fraud. This case was also very much similar. This company invested in some newly incorporated companies. Here there was something different. A new innovation was done. They bought shares of those companies which were not worth. So money was given for acquisition of shares. When a shares are acquired, what would be the normal way of evaluating whether those shares are worth or not? Net worth, right? Some valuation report, something, some business model being there in that organization. Nothing doing. A newly incorporated company, they bought shares worth thousands of crores at a very high valuation, high premium. This is what happens many times in startup also. You know, very, very rosy pictures are being created and company fall for it and that money goes bust. Here there were more of group companies being created. Shares were issued, debentures were issued to group companies without they being capable or credible enough to have that shares at that high valuation. After that money was going in that company, it was routed to some other companies and siphoned off. Loans were given to group companies, again without any recoverability. So similar modus operandi being followed. Group companies being created, a web of group companies. I'll give loan to you, you give loan to me. All those loans are then evergreen. They may, fund routed through some banks. So God knows what happens in this. So, clear flags of large scale loan defaults, round tipping of funds was there. Suspected companies, audit evidence shows no documentation of evaluating those things. Whenever an investment is done, the auditor should have evaluated whether these investments are at a fair value or not. Again, an impairment of asset, the investment was also required to be done. Nothing was done. There has to be some internal controls in a lending borrowing organization, that how would you lend to some company? There was complete lack of, there are seats here, sir, please come. There was complete lack of internal controls. Loans were being disbursed without doing the basic due diligence on a lender, on the borrower, which was required and mandated as by the internal control framework of that company. Again, NFRA noted that there were generic audit procedures which were copy pasted from templates without tailoring them to the specific fraud risk of the entity. There was the EP, the engagement partner, failure to document inquiry outcome with those charged with governance. We are required to communicate with those charged with governance as per SA 260. There was no communication being done. NFRA observed that the audit lacked critical documentation supporting the existence of internal control. internal control is something which we are required to check. We are also required to issue a separate report on IFOCR, internal financial control on financial reporting. There was no checking of the internal controls being done. Fraud risk, again, there are many anomalies in this. And there are mechanical way of just doing some fill in the blanks and paperwork was done, which the NFRA said you have not evaluated the existence of fraud as you are expected to do as per 240. And thus they were charged with a violation of SA 240. Again, here it was the auditor's responsibility to report the fraud to the central government. Here, what explanation they gave is they did report the fraud later on, but NFRA say time is the essence of any reporting. If you report a fraud after everything is gone, it's no point doing it. In this case, particularly, the auditors reported the fraud, but after a lag of around 4 months. So MCA came down them with heavily that if you report something, if you came to know so much earlier, but you reported so late, so you know you have not reported, or it was not important to report later on. SA 705 talks about the opinion, the modified opinion. We as an auditor are required to modify our opinion if we find that there is any misstatement or the audit evidence which we have gathered is not appropriate. There are 2-3 types of modifications which are mentioned in the SA 705. It could be a qualified report, it could be an adverse opinion, or it could be a disclaimer of opinion. Depending on the severity of the lack of the evidence or the misstatement, we have to change the language of the audit report and issue a modified opinion in 3, which could be in 3 categories, which could be qualified, adverse, or disclaimer. That the standard mandates that where the material misstatement is both pervasive and fundamental to the financial statements, the auditor must issue an adverse opinion. Similarly, if the audit evidence is insufficient and the potential effects of material and pervasive, a disclaimer of opinion is warranted. Disclaimer means I am disclaiming I am not able to issue a report itself. That is called a disclaimer of opinion. Here in this case, the auditors failed to comply with SA 705. There were major impairment of the investments, which we just spoke about. They made some investments which were worthless. Deferred tax asset, again, it was not having any value, though it was accounted for. Corporate loan books were there, which were again, dicey of recovery. Interest was not being serviced on times. They were doing their own loan restructuring. Their own defaults were happening in their books in terms of, from whom they had borrowed money. And thus, they claimed to issue a qualified opinion for the main report and a disclaimer of opinion on the IFOCR. But the nature of the lack of evidence was so much that NFRA said that you should have issued an adverse opinion and a disclaimer of opinion was required, and thus you had breached the requirement of SA 705. Friends, many times we are not focusing on the drafting of the report. Copy paste is the norm. Control F 2024, replace it with 2025 print. Please read the audit report. Read what we are issuing as in the audit report. Each and every statement has a lot of weightage, and whether we are able to substantiate those statements with our work. That is what is expected by the institute, all the stakeholders, and the government authorities. We say that we have obtained sufficient and appropriate audit evidence and the financial statements are free from material misstatement. How will you be able to substantiate that? We need backup of all these essays, the documentation file to prove that we have conducted the audit accordingly and we are able to demonstrate that. So please don't do copy paste of the audit report. Read the audit report once. Wherever it requires a modification, please modify that. SA 500 requires to again about the audit evidence. We spoke a little bit about it. Evidence. What is evidence? The need to evaluate the credibility of the management responses and information And independent sources, whenever we obtain an evidence from independent sources, it is has more weightage. Bank balance confirmation, independent source. Data's confirmation, independent source. So this evidence will have more weightage than evidence which we have gathered from the management itself. So we need to have our evidence which will be more elaborate, more corroborative evidence should be obtained each and every time. So the auditor must consider both the quality and the quantity. We are speaking again and again of the audit evidence what we obtain. In this case, the auditor failed to obtain adequate audit evidence. It relied entirely again on management explanation for critical assertions without independently evaluating them. Direct confirmations for lender were not sought. Loan agreements were missing. No procedures were there to trace the end use of the disbursed funds. Funds were going where they were going. There was no end use letter. Whenever your client borrows, we are always required to give end use certification, whether the funds have been used for the purpose which it were borrowed. So these procedures were there on paper at this company, but they were not obtaining it from the person who had borrowed funds from them. Control testing walkthroughs were not done. Loan approval disbursal process was not followed, and misstatement of thing. In multiple instances here, they just aligned, to the management assertion. Management say yes, the auditors accepted each and everything what the management gave, and without evaluating it internally through their common sense and knowledge. So the level of the documentation evidence was very, very poor in this case. The investments here we spoke about, it failed to verify the legitimacy of the investment made by the company in several suspected bogus claims, and no procedures and documentation were followed. The lapses signal the breach of SA 500 and the requirement of the reliable and sufficient audit evidence in the audit team. Documentation again was lacking in this case. About SA 230 was violated. It was grossly negligent. They did not compile their file. The audit documentation was not signed off enough. It was not indexed. No traceability of the documentation was available. And the assertions made in the audit report and communications with regulators were not backed by any audit work, making it impossible whether the procedures were actually followed and performed or simply recorded post facto. In this case, the penalties were a little harsher, less harsher, I would use the word, compared to what we saw in the Reliance Home Finance case. Only 5 lakhs for the partner and 5 years of debarment. So much milder than the earlier case. I think need to conclude here. Friends, the PPT will be shared with you. We call it a day today. There are some other engagements and Chairman sir is here. So other cases, you can read through it. The PPT will be shared with everybody. Thank you for the patient hearing.
Good morning, all. Good morning. We welcome Chairman Sir WRC and dignitaries from WRC, and we are also visited CEO officers. So just thank you, Chintan, on behalf of the University Studies. Some of the gentlemen saying that there is so Again,